The bull call spread is a powerful option strategy that allows you to express a bullish bias on a stock or an index with a terrific risk reward. In this video, you'll learn the strategy in detail, as well as how to turn a potential loser into a winner. Winning trades feel much better than losing trades. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7- and even 8-figure per year traders. Watch, take notes, and learn so you can experience the satisfaction of turning a losing trade into a winner.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And the traders on our desk trade many different and powerful option strategies, and we've shared many of those strategies with you on our channel over the years. In today's video, we're going to be teaching you a way to express a bullish bias on a stock or an index using much less capital than you might think to achieve a remarkable return in a very short period of time through a strategy known as the bull call spread. And of course, not every trade goes your way. And if you've been trading for any length of time at all, you're probably painfully aware of that fact. But the good news is that in today's video, we're going to be teaching you exactly what to do when a bull call spread goes against you, and how to manage your way out of that situation using a simple technique that we'll be teaching you, which can very frequently turn a trade heading for a loss into a winner. So stick around if that sounds like something of interest to you. Now, if you're absolutely brand new to options trading and you don't know much about how options work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for understanding the bull call spread trading techniques that we're going to be teaching you in this video. Then when you're finished, you can come back and watch the rest of this video. Let's head back to July 12, 2023. And as you can see from this chart of the SPX index, the SPX had been bullish all year. And on July 12th, the index broke out to the upside, closing at its high for the year of 4472.16. And so suppose that you saw this breakout as a bullish sign that the market was going to continue to rally for a little while longer. And so let's say that just before the close on that day, you decided to pull up an options chain that expired about a month later, the August 10th options chain. And you went ahead and sold the 4450 call, a call strike a little bit lower than where the index was trading that day, and then went farther lower on that chain, 100 points lower, and went ahead and bought the 4350 call. Well, if you did that, selling a call higher up on an options chain and buying a call lower on that same options chain, that trade is what is known as a bull call spread by options traders. It is frequently used when a trader is bullish on a stock or an index. Okay, so let's take a look first of all at the cash flow of this bull call spread so that you can begin to see how it works. And so starting with the call we bought, that 4350, we bought that at a price of 158.65. But remember, index call options pay off at a rate of $100 per point above the call strike price. So you multiply that price by 100, and that results in a payment of $15,865 for that call. But then you're simultaneously selling the 4450 call right below where the index is trading, and you're selling that one for a price of 80.70, which if you again use that 100 multiplier, that means you're receiving back $8,070 for selling that call, resulting in a net cost of $77.95 for buying that call spread. To understand how this trade works, let's move to the day that it expires, about a month later. And as you can see, the index did initially rally as you expected, but then eventually pulled back in. And on the day the bull call spread expired, the index had actually pulled back a little bit and closed at a price very slightly below the price it was at when we entered the trade in the first place. And so now we're in a position to assign a final settlement value to the bull call spread, because when options expire, they either have zero value if they're out of the money, or they have some value if they're in the money. And so let's break down the value of each of the options, and let's start with the one we bought, that 4350 call. And so to figure out the value of a call, we have to figure out how much it is in the money on expiration day. And so you subtract the closing price of the SPX from the strike price of the 4350 call, and you get 118.83. But that call pays us $100 for each point that it's in the money. And so that call is worth at settlement $11,833, as you can see from the calculation. But don't forget, we sold that 4450 call. And as you can see from the calculation, that one is worth $1,883. But we're short that one, meaning that we are the ones that owe $1,883 to the one we sold that call to. And so you've got to subtract that out. And so the net of what we get paid for owning the 4350 and what we have to pay out for having sold the 4450, the net of those is exactly $10,000. And we're going to come back to why that's $10,000 in a minute. But to finish this analysis, we have to finally deduct out the original cost of the trade to arrive at our trade profit, which is $2,205, which against that original $77.95 is a 28.2% return in slightly less than a month. Now, what's interesting is that even though this was a bullish play, the index actually closed slightly below where it was on the day we entered the trade. And that's one of the magical things about bull call spreads. You see, think about it. Suppose that the index, instead of closing at 4468.83, suppose that it had closed, say, at 5,000. Well, in that case, the 4350 would be 650 points in the money. Thus, it would be worth $65,000. But the one we sold at 4450, well, that will force us to pay out $55,000, as you can see from the calculation. And so the value, despite the index closing so much higher, hasn't changed in value. It's still $10,000. And that's because as soon as the index closes anywhere above 4450, it activates the value of that short 4450 call. And so once the index closes at 4450 or above, and this is crucial to understand, the bull call spread will always be worth exactly $10,000 because once the index is above 4450, the cost of our having sold that 4450 call will increase by exactly the same amount as the value of our owning the 4350 call. And the result of that is that the trade is frozen at a maximum value of $10,000. And so as you can see, even if the index had closed a little bit lower, but above 4450, as long as it stays above 4450, the bull call spread will be worth $10,000 exactly. Okay, so that was an example of a successful bull call spread trade. All right, now after that first successful trade, suppose that we decided to reinitiate a second bull call spread on the day that the previous one expired, keeping our capital active in the process. And since the market pretty much closed at the price we opened the first call spread at, which is just a coincidence, we actually can coincidentally initiate the same trade, again, buying the 4350 call, but this time expiring September 7th, again, about a month later, and selling, again, the 4450 call 100 points above that, just like we did last time. But the prices are going to be a little bit different for a variety of reasons, which we can go into in another video. But for now, let's just focus on this new trade and how much it costs us to enter this particular one. And as you can see from the calculations, the $15,730 that we paid for the 4350 call this time is offset by the $8,325 we received for selling the 4450 this time, resulting in a net cost of, in this case, $7,405 for the debit spread. So a little bit less than the cost of the previous one. And just like we explained on that last trade, if the market closes at or above 4450, then the debit spread will be worth $10,000 regardless of how much higher than 4450 the index reaches on expiration day. And so as you can see, that means that the most we can make for this trade is $2,595. Okay. So as it happened, immediately after putting the trade on, SPX actually started to sell off, so that by August 18th, the index was trading at 4346.90. And so naturally, when that happens, the prices of calls are going to be going down because they gain value when the market rallies and they lose value when the market sells off in almost all cases. And so taking a look at the debit spread, you can see that the prices of both the short call and the long call have dropped significantly. So what does that mean to the value of our debit spread at this point? And so the way you calculate that is to ask yourself, what loss would I have to take if I exited the trade at this point? And so to do that, you'd have to sell off the long call at 44.50, as you can see, would have brought in 6,975, and bought back the 43.50 with short call for 22.95, resulting in net cash inflow from closing the trade of 46.80, which means, as you can see from the calculation, that you would have lost 2,725 had you exited at that point. And so what to do at this point? Well, at this point, when you're down about as much as you could have possibly made on the trade, which is the situation we're in right now, they're very close, most bull call spread traders would execute what is known as a roll of the trade, and if necessary, increase lot size in order to restore the potential income of the trade. So let's show you what we mean. So an example of this is, suppose that on that day, we went ahead and closed the original position, selling off the 43.50 and buying the 44.50 call back, which effectively closes the position, but then simultaneously, we roll the position down and increase the trade size to a 2-lot, selling 2 calls at 43.25, the next 25-point strike down from where the market's trading, at which is 43.4690. And we also buy 2 of the 42.25 calls. So again, we've constructed a new bull call spread, again, 100 points wide. So now it's important at this point to take stock of where we are. And so starting with the initial cost of the first 1-lot bull call spread expiring in September, you'll recall that we paid $74.05 for that. And we deduct from that the proceeds of selling the 43.50 call, which is $69.75. But then we've got to pay $22.95 to buy back the short 44.50 call. And then further, as you can see, we spend an additional $31,880 to buy the 2-lot of the 42.25 calls, but that's offset significantly by the $17,080 that we brought in selling those 2 short calls at 43.25. And so, as you can see, the total we've got invested into the trade at this point is $17,525. And so the new position looks like this: a simple 2-lot bull call spread, 100 wide, moved down much lower than the original trade was located. Okay, so now let's move to the day that this September 7th position expires. And you can see the SPX ended up bouncing a bit, closing at 44.5114. And so at the end of the day, this position expires and a final value will be assigned to the options comprising our bull call spread. So let's take a look at that. And as we covered in the first example, you subtract the price of the index from the strike price of the call and multiply it by 100. And of course, we had a 2-lot, so you need to multiply that in turn by 2. And so multiplying that all together, it turns out that the 42.25 calls can be cashed in for $45,228, while the 43.25 calls that we were short, those need to be bought back for $25,228, resulting in a net value of $20,000 in this case, which makes sense, right? Because we're trading a 2-lot. And so the position has a maximum value, which is twice the value of a 1-lot. And as you can figure, at any price above 43.25, that debit spread would still be worth $20,000, as we explained to you earlier. And so finally, subtracting out the cost of the entire trade after we made that roll, in other words, subtracting out the $17,525, the net profit on the trade is $2,475, which comes to a 14.1% return, significantly lower than in the first example, but still a very strong 1-month return on a trade that was initially, remember, going against us. So what I'd like you to take away from today's video is that when trading a bull call spread, your fate doesn't have to be tied to the original trade. When the market moves against your position, you have the option of rolling that position, which gives you a second shot, basically, at making money on the trade. Now, in these cases, as happened in this example, in many circumstances, you may need to increase your lot size to deal with the fact that you now have a lot more cash invested in the trade, as we did in this example, and you'll need to be able to cash in a larger position at the end of the day to accommodate that fact. And so you need to be aware of that possibility when you first enter the trade and make sure you've got sufficient capital in your account for such a potential roll. But assuming you do, in many cases, you can salvage a trade going against you and bring it home for a win.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.